Hello and welcome to another episode of the Express Economist. This week, we'll look at something called the trade deficit. As many of you might have read in the newspapers, India's trade deficit for July came out to be on an all-time high. What is quite remarkable beyond the fact that it was on an all-time high was that the previous all-time high was in June and the one before that was in May, which essentially means that for 3 consecutive months, India's trade deficit has been hitting an all-time high. Now, why is this such a matter of such a massive worry? Why is everyone talking about it? People are saying that this would have an impact on rupee's exchange rate, that RBI's monetary policy that will get affected because of this. In this episode, we'll look at what is trade deficit, and I'll answer some more questions that you might have about it. For example, why this is not a new thing. Secondly, why is it growing too fast? Thirdly, why does it matter if it's growing too fast? Fourth, what's causing this? And fifth, what can be done about it, or what can arrest this spiraling trade deficit? So now let's start by first looking at what is trade deficit. Now, in any country, people of that country export a lot of goods which are bought by people of the rest of the world. And similarly, a lot of commodities from the rest of the world are bought by the people of the country. So Indians import a lot of stuff, a lot of goods, and I'm not talking about services here. This is only about goods. And similarly, Indians export a lot of goods. Now, trade deficit is essentially the difference between the exports and the imports. And now, why do we call it deficit? Is because typically in India's case, we've seen that almost all the time, every year, every month, we tend to import more and export less. And that turns out to be a deficit. This deficit can be expressed in money terms. We can look at it either as Indian rupees in rupee terms, or we can look at it in dollar terms, in millions or billions of dollars. In this episode, we'll look at it in millions of dollars or billions of dollars. Now, the deficit is essentially the difference between the monetary value of all that you exported and all that you imported. So let's understand this with the help of a chart. In this particular chart, you'll see we've mapped both the exports and imports. And you'll broadly find that in any given month, the imports are higher than the exports, and that's why the imports chart is always above the exports line. The difference between these two lines is essentially the trade deficit. Now, we are charting here for the last 3-4 years, and you can see that the trade deficit was a substantial bit, and then it collapsed as all of trade collapsed during the COVID pandemic. There was no import, there was no export, and all of that largely collapsed, and your trade deficit also collapsed. But as the economies have recovered, both the global economies and India's economy, you can again see them diverging. And towards the end, as you come towards the end of the graph, you can see that gap has increased, and it has increased because of two reasons. The imports graph is still going up, whereas the exports graph in the last few months has started coming down. So the gap has increased because of both the reasons, that imports are soaring and exports have started stagnating or contracting. Now, the obvious question is, if India always had trade deficits, big or small, what is the fuss? Why are we fussing about higher trade deficits or all-time highs right now? And there's a reason for it. Let's look at it in an annual sense. How much was the trade deficit in any particular year? And I've just charted out some of the trade deficit in the last 3-4 years. And I've also charted out the trade deficit that we have already accumulated in the first 4 months of the current financial year. And what you'll see is that the current financial year, we have already racked up the same amount in terms of trade deficit that we had in the COVID year, that is 2020-2021. That particular year, whatever was our trade deficit, we've already almost covered that much. We've already accumulated that kind of deficit. We have, in the year that we recovered, that was the next year, that is 2021 and 22, the last financial year, that year our total trade deficit was around 190 billion, and we are almost halfway through there. And this is only the first 4 months. And essentially, the point is that yes, the trade deficit is a natural thing, it sort of has happened all the time, but the rate at which this is happening, the rate at which it is expanding, is quite remarkable. At this rate, you can imagine the total trade deficit really expanding to very high levels. So the next question is, okay, if it was trade deficit, it is a normal thing, maybe we are accumulating greater trade deficit. Well, what's the point? What does it all mean? Why should we even care? Ultimately, trade deficit is nothing but an accounting measure. Why should it bother us? Now, the reason why we should bother about it can be seen from a chart on the rupees exchange rate. Let's pull that up. Essentially, when you are importing more than you're exporting, your demand for dollars is higher. And when I say your, means Indians. India's demand for dollars is much higher than the rest of the world's demand for rupees, right? As a result, in that foreign exchange market, in that market for different currencies, rupees value falls. Nobody is demanding it. More people are demanding dollars because the trade deficit is high. You're importing more. And it is so sharp, such a sharp increase in trade deficit essentially means that there is a spike in the demand for dollars. And that is what you can see reflected in the rupees exchange rate. In this chart, you'll find that the rupees exchange rate is rising. But this is a reverse kind of a framework, because it's showing that for every dollar, you're now requiring more and more rupees to buy that $1, right? That is what is happening. So over this period where we have seen our, trade deficit increase, basically the difference between our imports and exports increase, we've seen rupee getting under tremendous pressure. And you hear there's a lot of, politicization about rupee's exchange rate, and there's a lot of concern about rupee hitting 80 to a dollar. It has come back a bit, but there's always this pressure because we are importing more and more all the time, every passing month. The pressure is continuously there. So to the question of why does it matter? Because such a sharp increase in trade deficit would tend to put a lot of pressure on the rupees exchange rate. And when the rupees exchange rate rises, you all know what happens. Importing anything becomes costlier. Now you would have to give more rupees to buy the same $1 of crude oil or $100 of crude oil. Studying outside would become that much more costly for you. So that is why it matters that the trade deficit, even if it is there, it should not rise so fast that in a short period of time we are covering or accumulating the same kind of deficit that we typically accumulated in a year's time. So now the next question is, what is causing this? Why is our trade deficit rising so remarkably? Now, let's look at two charts here. One is to look at the exports growth rate of exports and the growth rate of imports. And what you'd find is that the growth rate in imports is growing at much faster rate. The imports growth is much faster than the exports growth. And in particular, look at the last few months and the last month in particular, July, you'll find that the data shows that we actually contracted. And these are year-on-year comparisons. So basically what the data is showing is that whatever we exported in July last year, 2021, this year in 2022, in that July, we exported less than that, right? And not to think about what all price rise happened and everything, but still in value terms, we actually exported less than what we exported last year. But if you look at the imports side, our imports grew up by almost 44%. In the month prior to that, they grew by 57%. The month prior to that, they grew by 63%. Compare it with the exports. They grew by 20, 21%, 22%, and then contracted by almost a percent. Now, this is about the numbers thing. And the July fall is, if you can see on the chart, is the contraction since the first contraction since February 2021. Now, this is about the data. What is causing this data to happen? Obviously, there's a discrepancy or a gap between our exports growth and imports growth is obviously the reason for this. But what's causing that? Now, there are three factors for, broadly speaking, for this. One is that there is a global slowdown. What does that mean? A global slowdown means that the economic growth in many other countries is slowing down. You must have heard about US. In the first 2 quarters, that is the first 6 months of 2022, their economy, the US economy, is actually contracted in both the quarters. Now, that basically means that their demand for our goods, which is our exports, is slowing down. So trade deficit, as I explained, it's a gap between exports and our imports. If people from the rest of the world are not buying our exports as much, then that will increase our trade deficit. So that is one part of it. Even the recent IMF data shows that the expectation for global slowdown is likely to stay. So this is one factor that will continue to put pressure on our trade deficit because our exports will be less in demand. The second factor for increasing trade deficit is what's happening in the domestic economy. India's economy grew at almost 9% last year, is expected to grow at around 7% this year, and even around 5.5%, 6% next year. So in contrast to the rest of the world, which is slowing down and demanding less of our goods in terms of exports, we are growing, we are recovering, and our demand for the goods of the rest of the world is increasing, which means that our imports will continue to increase, and they are increasing. So that is what the trend is showing. So robust economic recovery at the domestic level is another factor which is pulling the trade deficit, because this is pushing up the imports that we have in every particular month. The third factor is to do with some government decisions. At the start of July, and this is very important because in July again we hit an all-time high. At the start of July, government put windfall taxes on the export of petroleum products, petrol, diesel, aviation turbine fuel. So what does that mean? If you slap a tax, the export of these commodities comes down. Now, petroleum exports is one of the top, possibly the second most important export in terms of value for India. So when you put an export tax on it, the exports of that commodity come down. And we've seen that in this particular year, in July, the petroleum exports actually fell by 7%. And that had an impact on widening the trade deficit. The gap increased. Finally, we come to the question of what can be done about it. Now, there are 3-4 things that one can think about that may trigger a softening or arrest this spiraling trade deficit. Let's look at it one by one. The first is policy decisions. Again, government's policy decisions. And we've just seen an example of that. In July, government placed some duties on the import of gold. Now, it made it costly for us to import gold from the rest of the world. And we saw that in the data. For July, India's gold imports fell by 44%. So because the government policy made it costlier for Indians to import gold, gold imports fell by 44%. So that is one way to go about it. Government policy action can tweak certain bits of, it can either promote certain exports or it can hold back the import of other goods, make it costly by slapping some import duties. That is one thing. The second factor could be that if the global slowdown continues and some countries or many countries get into a recession mode and their demand falls, it is possible that many commodities which are right now running at very high prices, for example crude or fertilizers, because of the war in Ukraine, their prices may fall because less of it is being now demanded. If that happens in the coming few months, that will bring down our import bill. So, while we might be importing the same amount of crude oil and the same amount of fertilizer, we might be paying a lesser price for it. And so, in value terms, the trade deficit may decrease. The third factor could be the rupee factor. One of the reasons why rupee depreciates when trade deficit increases is that obviously less of rupee is being demanded, more of dollars are being demanded. So as against another country which might be selling the same commodity, the Indian good might be more attractive because an American can have more of it for $1. So as the rupee depreciates, it may trigger a salutary effect on India's exports. So even when their demand maybe is falling, they might prefer to buy from India because India's rupee is falling. And that may have a salutary effect in pushing up the exports and bridging the trade deficit. The last factor is a more long-term factor. And this cannot happen in 1 month or 2 months. And that is about India becoming a better and more efficient place to produce goods. Say a place like Germany, they tend to export far more goods than they import. Why? Because they're really good at it. They actually are very cost efficient. They give very good value for money. So can India become that? Can India become such a good place to manufacture goods that over time our exports increase? And when they increase, that bridges the gap between the imports that we have and the exports that we have, and the trade deficit falls. But that's a long-term thing. It cannot happen in 1 month or 2 months. So that's the whole gamut of array of options that India has in terms of how it can go about arresting the trade deficit. So that brings us to the close of another episode of the Express Economist. The Express Economist is a weekly show. It comes out every Friday. If you like it, please press the like button, subscribe to the channel, and I hope to see you next week.